Hello guys, welcome back to my channel. So today we are talking about the discussion in the corporate finance, that is the continuation part of the hurdles of the estimation, like taking the betas and controlling the betas, and how to provide the estimation for the beta. And today's topic of taking is, that is, estimation betas and the fundamental topics, and adding upon it the topic will be seeing about it is one of the type of the approach that will be taken as the beta factor. So we have seen a lot discussion about the regression factors. So today we are going to see non-regression type, like top bottom model. So today we are going to see that, but first we are going to see about the fundamentals that we talk about the betas. So in this session we are going to talk about the better ways of estimating the betas. So the fundamental decision you make, so that you can make the difference in the estimation, type of the businesses you should be in, so that the money will be borrowed according to that, or the money will be lent according to that. So that you can pay the debts or you can take the risk according to that. So suppose we have an example of taking some companies which have the uh, basic estimation of the data, or the beta will be already estimated by us, as we know by them, because we of the companies which they trade or which they according to work in them. So basically we have taken four types of betas in the stage, or a beta, where beta is greater than 2, beta is in between of 1 and 2, means greater than 1, beta is in between 0 to 1, means greater than 0, means the point not value, 0 point not values, and we will be seeing beta which is lesser than 0, that is means negative. So in this model we will be taking first beta is greater than 2. So we have seen here a company that is known as the Bulgari company, which has the beta more than the 2%, that means 2.45, it has 2.45, so that it has a high efficiency in its product. But here the minus in this is a high efficiency company, so that if the beta is greater than 2, then the model will be running is running at a higher efficiency. So if you invest in this, the investment will be happening here will be called out or ruled out with the profit, where if it has higher amount of sales, but if it does not have any sort of higher amount of sales, then the company will be going into debt, so that it will be going into losses, your share will be going into losses. So the beta between 1 and 2 will be taken here, so that we have different types of companies here, like Microsoft, GE, and Quest Communications. First we will see according to the Quest Communications. So Quest Communications is a company which is a telematic company, which gives the communication systems to all of the people, which acts like a geo for us in India. So that will be taken in the form of standard beta, that will be stable, with the prices or the offers of it will be stable until the beta does not go or increase into them. So if the prices change, the beta also changes. Generally it has 1.86% of the beta, so that it is nearer to do, but it is not that riskier as the Bulgari company. So next one is known as the Microsoft company. Microsoft, at first it has two company, to mean greater than 2 beta, so that it has changed its it has been reduced to 1.25% when it has become a largest company that has been ruling the world, so that it is now of 1.25%, because if you are investing 1 rupee in that, you will be getting 1.25 into it. So this is the sort of data that will be taken in the 1.25% ratio of, where this is a gigantic company. Now we are seeing another company that is 1.15%. The 1.15% of is GE company. So the GE company has the different types of, or different sorts of investors in that, or it will be investing in different sorts of matter. So that the main investment of the GE will be going into the GE Capital. So GE Capital is a financial based company. So it has the per capita income or the data that will be provided for us. But here we can understand the process where the finance corporation companies will be having the higher debts according to them, because they will be lending the loans to the people. So the capital will be having the highest amount of income from the GE company. So that here the 1.15% shows us the beta range where we can invest according to our risk. So this is about the betas in between 1 and 2, or the companies that are in between 1 and 2 beta. So far we have seen that we can know that the bigger companies growth towards the companies which have the higher income or the higher status of income, or vast companies, will be more diversification will be happening in them. Means diversification means so much market portfolio, so that you will be having different types of people that will be investing into them, so that it will be going into the towards one. Means we have seen from the top to bottom, so that we have seen 2, next we have seen 1.86, we have seen 1.25, next we have seen 1.15. So now we are going towards the beta which is less than 1, that is 0 point something. So we will be taking two companies here. So ExxonMobil will be having as an petroleum corporation company, where it will be having, or the oil lubricant oil sort of company, where it will be dependent on the prices of the petrol. So prices of the petrol will be maintained by the company or the country, so that if the prices of the petrol increases, this ExxonMobil, the beta will be also increasing towards the one, and if the prices of the petrol decrease, it will going towards zero. So that here the prices of the petrol will be determining as the country says, but the basic rate of the ExxonMobil is 0.70. It might be rising from 0.70 to 1, or 0 0.6, it will be going into 0.6, 0.5, like that. So we will be seeing a second company, that is Altera Morris, means it has the 0.60% of its probability income, so that it will be having a marginal ratio of getting the profit into it if you invest into this. So next we will be going into the beta which is less than 0, means negative values. So the gold companies are the example companies for this. So we have taken here the Harmonic Gold Company, which is of minus 0.5 ratio, where we cannot see the expected return according to that, but in this factor in the beta, the gold prices are actually always high. So if you are investing in this, if the gold rate is increases, then it will be going into the fields that will be having positive value, or the beta will be greater than 0. But here it will be not having any sort of information that we will need as of now, because we are not having it is a gold company, because it is only just after of digging and mining, so that it will be having this 0.15 ratio, negative 0.15 ratio. So that is about the betas that we have seen now. So the negative beta means there is a macro risk in that, so that you need to have insurances for every sort of rupee that you invest into any sort of these companies with the negative betas, means beta which is less than 0. So by assuring we have an income, or assuring we have an some sort of insurance for us, so that we can be happily being for us with our money, because if it goes into loss, you can claim the insurances, and if it comes as a profit, you can be staying with that. So there will be different types of determinants that are required for the beta to be there in the company. So that first one is of the product type. So which product type are you selling, or which product type is the company selling? So industry effects means in what industry will be showing the effect out of it. So industry effect will be the beta volume or the beta value for a firm depends upon the sensitivity of the demand, upon the sensitivity of the demand for the market in its product. So if the product value is too much high, and the demand is low for that, then the company will be having lesser amount of sale in that, so that it will be having higher amount of beta. So that now if you see into that, the macroeconomics will be having the factors, so that overall the company market will be showing according to the supply and demand. So the cylindrical companies have higher betas than the non-cylindrical companies on the firms, because the firms will be according to the investment that we have made, or the investment that we have been encouraged to put on a market based or the product based company. So the firms which will sell the discretionary products, means different types of products, will be having higher betas than firms which are selling the rest discretionary, means that will be having the less discretionary, means that will be having lesser amount of products. Means if you see, first suppose we have only Cello which will be selling only pens, but Himam will be, or Hindustan Unilever will be having different type of products like shampoos, soaps, and different types of products. So that companies will be having different higher amount of beta, because it has a risk, but it will be having a higher profit when we have got as a refund. So the return. Then the second determinant is known as the operating leverage effects, means cross structures. Operating leverages will be having the proportion of its total cost which will be fixed by the firm. Means it will be having the main fixed price, so that it will be not changed according to the market, or the other things will be remaining equal, because the tax will be paying according to it, or we will be earning the profits according to it. So that we will be the seeing first the operating leverages, which is known as the second determinant for this estimation of the beta. So how we will be seeing the measuring the operating leverage? So fixed cost measure is equal to fixed cost by variable cost, where this measure is used for relationship between the fixed and the variable cost. So the higher the proportion where the operating service will be having more, then if we increase in that, we will be having higher the operating leverage. So we will be seeing according to that. Now we will be coming into see EBIT variable to measure. So operating risk can be defined as the variability of the EBIT. The environment and the internal and external in which the firm operates determines the variability of the EBIT, including the tax and deviations. So EBIT measure variability in the percentage will be taken for percentage in the change in the EBIT by percentage change in the revenues. So measures how quickly you have earned the interest rate and the taxes that we have already invested into that, or the refund how we can be calculating it. The higher the number of the return, then we will be having the as I said earlier, higher the operating leverage. So we will be talking about that. The third determinant is here. The firms that borrow the fixed deposits or the fixed posts that will be having of the earnings, we will be taking from the beta of the equity, which is taken from the revealed data of the debt equity ratio. So we have seen different types of data where we will be having the equity debt equity ratio, or we will be taking different sorts of information, where we will be discussing today about the levered data and unlevered data. So briefly, what is levered data and unlevered data? I will be telling now that levered data will be levered beta will be the measure of the market risk, where the debt and the equity are factored, where the assessing of the company's profile in the risk ratio. Next, the high we will be talking about the unlevered beta steps that will be taken the debt company or the components to the isolate the risk due to the company's assets. Means it will be not touching any sort of the asset of the company, but it will be taken as a risk because it is an unlevered beta. So high debt to equity ratio will be actually translating as to increase the risk in the associated companies or the stock products. Means if you are invested in different types of companies, but here the risk is more, then you can know that the refund or the return will be less, so that the return will be actually gaining needed to in the sort of risk. Means you will be taking the risk to invest into that. So we have seen the different types of data and different types of information that will be required for us to estimate the betas and the fundamentals that it derive. But here we need to know that there are different type of approaches that will be taken, that we can take for proving or solving any sort of problem. So that if you here we can clearly say that for approaching any sort of method, we will be having, if you can't find a comparable company, then it is because you did not look at it so hard. So the betas are always at the weighted averages. So the beta of the market profile portfolio will be having is always weighted averages of the beta of the individual investments in the portfolio. So thus we can say like that, we will be saying the beta of the mutual fund weight is overweight, and weight average with the taking of the betas in the stocks and other investments in the portfolio. So here we will be taking the mutual fund, as we invest in the mutual fund, the main risk in that will be avoided, so that the mutual fund will be actually acting as an weighted average of the betas of the stock and the in other investments in the portfolio. So all the investments that are made will be taken in the average of the betas, and the beta after a firm value will be merged into this market value and the weighted average of the companies involved in the budget. So now we will be taking the two types of methods that we will, as we have discussed from the starting, the bottom up and the versus the top down beta. So the top down betas come from an regressions, but the bottom up beta can be estimated by doing the following things. So to find out the businesses that are operating in, means the where if you are investing in a company, find out that what companies it is established in, or what companies it is working in, and what other companies it has been already invested into that. So we will be first finding about that, and next we will be finding the unlevered betas of the other firms in the business. As I said, no, it is not touching any sort of assets of that company, so that we will be seeing the finding unlevered betas in the other firms of the company, and take an average of the unlevered betas and levering up it using by equity ratio. So the equity ratio, debt equity ratio, we will talk about it in the later one, but we have seen the information that is required into that. So one thing we need to be clear about, this is the process that will be taken now. That is the part of being the precise to the main firm, means it will be seed according to the data that is given for in the sort of the main problem or the main issue or the main firm. Because if you are making an estimate out of an company which has no estimated firm, then you cannot take any sort of result or the data that will be taken into form of that. So the bottom up data that will be acting as an method for which is calculating the beta is more accurate than the top down beta model or the method. So the following reasons will be for showing as the bottom up beta will be more efficient, or the more estimation will be, we can say that standard error of an beta estimate will be much more, means it will be much more in the top down method, so that the bottom up beta method will be acting as an pre ultimate for the taking as an estimate. The betas can reflect the current and expected future mix of businesses that the firm is in the rather the historical mix. So unlevered beta, or the one which is taken for us right now, will be having the information of an historical mix, means the in the past few years how much you have taken the information about it, and the present how it is dealing with the past history, and we can say all of that in the by calculating in the bottom up beta, but it is not seen in the top down beta mode. So unlevered beta, which will be taken as an or the levered data, levered one will be taken as an beta appreciation for the estimation of the price, where we will use the formula that is unlevered beta by 1 minus cash into firm value will be having as an companies that will be taken as a primary input, so that all the companies have their own betas in their estimation, where we have seen in the bottom up one, where we have discussed about it. It will be actually seeing about the different types of companies we have already invested, that the company which is we are going to invest is already invested in, so we will be saying according to that. Now we are coming back to the situation where we will be seeing the pure play data, where we will be having the we will be taking the different types of steps that will be involved in this. So start the median regression beta, means equity beta, and unlever the data that is used by DE ratio. DE ratio is debt to equity ratio, that is actually got by value of the total business by allocated debt, means the debt which will be taken for clearing all sort of amounts, and take out the cash effect using the median cash. So but first of all, what is a median? So what we need to know, what is about the median. Median means the average, basically the average. So median is the middle number of the sorted. It is not not the average, but it is the middle number of the given list or the sorted list. So to determine the median value of the sequence of the numbers must be first sorted and arranged and in order of the lowest to highest or highest to lowest, so that you need to take the middle one out of them. So you can be taken like if you are going, for example, we have 5 to 10, 5, 6, 7, 8, 9, 10, then you can take for 7 like as an middle number, or 8 as a middle number. So it will be only given for an odd number of values. So you need to take for odd number of values, so that you can go for 5 to 9, so the 5, 6, 7, 8, 9, and you can say that 7 is the middle number out of it. So you can take like that. Then you need to that is about the median. So beta of a company can be told by beta of a company will be the beta of the operating assets into value operating assets by value of the operating assets plus value of the cash, and the beta of the cash into value of the cash by value of the cash plus value of the operating assets. So this is the formula that will be taken for us for telling any sort of company's beta. So this is how we have known about the betas and the different types of betas like unlevered beta and level beta, where we can see that if you want to know about the unlevered beta or levered beta, the formula will be the unlevered beta is equal to levered beta by 1 plus 1 minus tax rate into debt equity. So ratio that will be taken as an input of an estimate. So we have talked about it now. So this is how we have learned about the betas that we have talked about, the betas that we have fundamental individuals that we need to take about the care of. Thank you.